Hi and welcome everybody. This is Mike Coval from IncomeTrader.com, and I thought I'd give you a quick introduction on cryptocurrencies. I'm getting a lot of people asking me, what are they, how do they work, is it something we should be investing in, should I put my money into them, how risky, how safe are they? So I thought I'd just do a quick maybe 15-minute video on what cryptocurrencies are, how they work, and kind of give you a starting place if you want to go back and do some more research on them. Before I do, because I'm going to be looking at some examples here, I just want you to know that everything I do cover is for example and illustrative purposes only. I'm not recommending that you go out and buy any of these cryptocurrencies and say, oh, I just heard a 15-minute video on what they are and I'm going to go ahead and start investing in them now. But this is just going to be an introduction to them, how they work, so you decide if they actually fit your personality or not. So let's just start off with what is a cryptocurrency. It's a decentralized peer-to-peer digital cash payment product with no central server. In other words, it's not like a bank where you would go to a bank and you would put your money into a bank and you'd borrow money from a bank. That's a centralized server. So you've got all of your information at one server and maybe backed up someplace else. A cryptocurrency is a decentralized peer-to-peer, which means there is no one place that holds all your information. Every type of the transaction, every part of how much money you have in your digital wallet, what type of transactions you do, are all spread across many thousands of different peer-to-peer networks. Those are called miners or nodes. The peer-to-peer system is set up and supported by cryptocurrency miners, and these are going to be important because this really tells us how they work. And a lot of people say, is it really just one kind? Because what we've been hearing about is Bitcoin, which I have kind of a little example right over here for you. But just know that Bitcoin, when you see these examples here, Bitcoin isn't a real coin. It's a digital coin. So when you see these examples that I have here right now, it looks like you've got a picture right here of a Bitcoin. It really is just an image that people have used as a logo to show what a Bitcoin is. This isn't a real Bitcoin. So when people say they have a Bitcoin, they don't actually have a physical gold coin in their hand. They have a digital currency in a digital wallet. So cryptocurrency. Bitcoin is one that most people think about. It was really the really first one to come out that really did well. And it's the world's first cryptocurrency. And a cryptocurrency is really just a digital asset which is secured by math. It's just a mathematical equation that miners, data miners, go back and they find the mathematical equation for part of what's called a blockchain, which I'll explain in just a second. And when they do that, you now have a coin. You have a place we call a Bitcoin. And then we can go ahead and use that Bitcoin to buy and sell transactions. So think of it like, in just a quick scenario, think of it like a password protecting code on your phone or your computer, and you have a 256 encryption password, and you want to try to go crack that password. Well, if you could crack that one password, well, then you would have a Bitcoin, and now you could actually use that what's called a blockchain. We could go ahead and buy and sell with that. So it'll make some sense in just a second. Bitcoin has no physical presence whatsoever. To have a Bitcoin is to control a Bitcoin wallet with positive balance. In other words, a Bitcoin is just a digital mathematical equation that says you have X amount of dollars, and that's based off of what's called a coin or a cryptocurrency. Now, the cryptocurrency isn't real in terms of an asset. It's just a number. When you have that number has a value to it. So think of it as just a mathematical expression, 1, 2, 3, 4, 5, 6, 7, 8, 9, all the way up to maybe 30 or 50 or 65. And that number that you have has a value associated with it. That's really all digital currency is. And we can use that mathematical number to buy and sell. So how does it really work? To have any accountability, you have to have a record of all accounts, balances, and transactions. In order for you to actually say that you have something that's worth it, and let's go back to the early ages when maybe we used gold. You walked around with some gold, or maybe you had a really pretty rock. Let's go back to caveman days. But you had some gold in your hand, and if you wanted to buy something, you could actually shave off a little bit of gold, and based off of its weight, it would have a value associated to the weight of that gold, and you could use that gold to buy and sell things. And only because people gave that gold value were you able to actually buy and sell things. What if somebody said, gold doesn't really have any value, we're going to use silver instead, or we're going to use rocks, or we're going to use dandelions. It's whatever people decided to use at that point of value. They gave it value to it, and then that value based off of how many you had at any given time would allow you to purchase things. Well, right now in this scenario, we're using something called cryptocurrency. And cryptocurrency is just a mathematical number, and if you have that number, then you have a coin, a cryptocurrency. Now with that cryptocurrency, you can go back and buy and sell. The value of that coin or that cryptocurrency, whatever you're trying to use here, goes up and down in value based on who's buying and selling it. So these are generally stored. So if we go back to how does this whole process work, generally you go through a bank and you put your money into a bank and you have what's called a fiat currency. Fiat just means it's backed by some type of a government and it has some type of an associated value because the government's going to back it. Like our US dollar, that would be a fiat currency. The euro would be a fiat currency. So every time you want to buy and sell something, you put your money into some type of a financial institution, and they say that you have X amount of US dollars in your bank. And because you have X amount of US dollars, you can then use it to buy and sell things using credit cards or whatever else you want to use. Cryptocurrency doesn't have one bank. It's a whole series of computers called data miners or miners. It's a whole series of these miners that have all of your transaction history of that digital number stored in all of their computers. So instead of just one, you have thousands of these different items out here. It could be hundreds of thousands, even millions of them out there. So if one server goes down, you have everybody else to kind of back up and make sure you're doing okay. So you don't have to worry about putting your money into a bank. You put your money into a digital wallet, which I'll show you how to do in just a moment. And with that digital wallet, you can buy and sell things. Right, with cryptos, it's all done peer-to-peer, meaning every computer does all this at the same time. So what did happen with an individual bank that said you have money at this bank and how much money you have in the bank, and they stored all of your transactions and your credit history and how much money you have in the bank at any given time, we don't have to worry about that. So there's no centralized place that does all of that. It's all done through these miners, or sometimes called nodes, N-O-D-E-S. So here's a really good outline that I found from Block Geeks, and it really does a nice job of explaining how the process works. So someone requests a transaction. So let's say that you've got your digital wallet, which is something you can download. You can go off to Apple Pay or Google Play, and you can download some software which allows you to, with the software, open up some type of a digital account. With that digital account, you'll deposit your current US dollars, or whatever country you happen to be in. You'll deposit your current dollars into that. Sometimes you can do them by a credit card. Sometimes you can do them by a bank transfer. Sometimes you can just do them by typing in your bank account numbers. Sometimes you can use your debit card numbers. But you physically put money into your wallet. Now with this wallet now has your cash into it, you're now going to go on to one of the exchanges and you're going to buy a cryptocurrency. So you're going to convert your US dollars to cryptocurrency. It's kind of like currency trading in pairs, where you might exchange the US dollar for the euro in a euro-US pair, or the dollar loonie, US dollar for a Canadian dollar. It's the same type of thing, but now you're just exchanging your US dollar for a type of a cryptocurrency, and there's over 1,000 different types of cryptocurrencies out there currently, and that number is going to grow as we talk. So you put your money into your digital wallet. Now with your digital wallet, you can go out and you can actually buy things with companies that actually take some form of cryptocurrency. So if you're on somebody's website and they say we take a cryptocurrency, and maybe it's Bitcoin because that's the largest one out there as of the time we're doing this quick introduction, you'll then go ahead and use your wallet and you'll send the money through them using what's called a private key. With that private key, you'll then transfer the money across. So using your digital wallet, you'll send your money across with what's called a private key, which just means, think of just like a regular credit card transaction, but instead of actually using your credit card, you're doing everything digitally. So this request transaction is broadcast to all the peer-to-peer, which means all of the data miners, all the nodes that are out there. In other words, instead of going to an individual bank to confirm that you have money on your credit card to buy something, your transaction is going out to thousands of these different miners, data miners, to confirm that you actually have the money in your wallet to make this process. So that money's going out to all of these different data nodes to confirm, which is called a peer-to-peer network, to confirm you actually have this. So you don't have to worry about one bank saying yes or no you have that. It goes to all of them at the exact same time. It's very quick. The network of nodes, also called miners, validates the transaction and the user status using known algorithms. In other words, it just confirms that what you actually have, what you're trying to buy, there's money in your digital wallet to buy this. Once the process is verified, the verified transaction can involve cryptocurrency for contracts, records, or the information. So as soon as you make this purchase, it goes out to all these different nodes, and they say, yep, you're trying to buy what you're trying to buy is inside this digital wallet. We'll go ahead and we'll confirm this transaction as a valid transaction. At that point, the transaction is now complete. So once it's verified, the transaction is combined with other transactions. So they now take this transaction that you just did and they add it to other transactions that are happening around the world at the same time. And by the way, you can do this with anybody around the world. So they take your transaction, combine it with other transactions, and they put it what's called a block. And so that's when you hear the term a blockchain. So they add your transaction to what's called a block, and then your block is then, once it's confirmed, your transaction is confirmed in this block, it's added to other transactions in what's called a blockchain. Now, once that's done, it's permanent. It can never be reversed. You can't say, oh, I made a mistake, I paid the wrong person. Once it's confirmed it's part of that blockchain, every other one of these nodes up here, these other data miners up here, has that transaction. So everybody has the complete transaction history on that blockchain, and it can never be reversed, erased, moved away. It's now permanent at that point of time. So anybody who wants to go back and take a look at your digital wallet can actually see, if they want to, how much money's in it, but it's not associated to your name. But your digital wallet has a transaction confirmed across it in this blockchain. So blockchain is really just a whole bunch of transactions together, and think of them as you're putting them in bricks, and you have one brick is one transaction, next brick is next transaction, next brick is next transaction, until you have this whole big chain of bricks called a blockchain. Now that blockchain is what can never be reversed, and so that's where you hear the people say this is a blockchain technology, because once your transactions in that blockchain, think of it as like a DNA chain. It's never altered, never changed, never reversed. So now the transaction is now complete. So your digital wallet tries to buy something from somebody else. All of the miners or nodes confirm that your digital wallet has the funds to buy this, verifies it, and that's done instantaneously, but it could take anywhere from 30 seconds up to maybe 2 hours, sometimes even a day, to actually confirm it, which means that it's now part of the new blockchain. And from that way, once it's part of the blockchain, every single peer-to-peer network out there that has that blockchain that confirms this, it's listed now as. And so that's why you can't erase it. You can erase it on one, but you can't erase it on everybody's at the same time, which means it automatically pops back up again because everybody else has that. So now the transaction is complete. So cryptocurrency, now it kind of makes some sense for you now. The cryptocurrency is a medium of exchange created and stored electronically on a blockchain. That's all that it is. Cryptocurrency isn't a real asset. It's just a mathematical number that you own in your digital wallet, and your mathematical number is associated with a value, and that value goes up and down based on how many people are willing to pay for that item. Think of it again just as a dandelion. How much money are you willing to pay for a dandelion? Well, what if everybody wanted to buy your dandelion? Price goes up. So the same thing with digital currency, because there's no asset behind it. It's just whatever people are willing to pay for it at any given time. So your dandelion you might have picked for free, and then all of a sudden people want your dandelion, so you'll sell it to somebody for $1, and somebody else says, that's a really great dandelion. They go out and they pick dandelions because the current price for dandelions is $1, and they start selling these dandelions all over the place. Now they go up to $10, and now somebody says, well, dandelions are crazy. I'm going to buy and sell clovers, and all of a sudden the price of dandelions goes down because nobody's buying dandelions, and they go down in value because there's no real asset behind them. Well, that's kind of in a sense what cryptocurrency is, because there's no real asset. It's just a number that data miners were able to find. So they cracked a code, like an encryption code, and when they crack this encryption code, they're able to take that code and make a new block for a blockchain. So when these data miners crack this encryption code, they can have a new blockchain. When they have a new blockchain, you can put transactions on the blockchain. And so that's how they get paid. But it's only what people are willing to pay for that cryptocurrency at any given time. There's no asset behind it other than it was a mathematical number that was in a crypto code that was broken. So in other words, they cracked the code, and they said, okay, now we've cracked this code, this part of the puzzle's done, so this part of the puzzle's now worth whatever the current price is. And it's whatever people are willing to buy and sell it for, whatever they're willing to pay for it. So because there's no asset behind it, it really makes it go up and down, quite volatile, based on whatever people are willing to pay for it. And so here's part of the drawback to that. So that it has no real value to it, in that it's not redeemable for anything like gold or other real currencies or anything else. A cryptocurrency isn't valid for anything. It's just whatever people are willing to pay for it, this mathematical number. But because they're kind of rare, it takes a while to crack the code, people say, well, this is now worth X amount of dollars. And the more people that are going to use that cryptocurrency, obviously the more value they associate with it. Think of it like the US dollar. The US dollar isn't really backed by anything. But if you have a dollar, you have a piece of paper that has a 1 on it, it's worth a whole dollar. I mean, the US dollar used to be backed by gold, but why is the piece of paper that's green, that has the US on it, has a $1 on it, why is it really worth $1? Well, because that's what we're willing to pay for it. It's not backed by anything other than the US government says that we promise to do our best job to make sure that you always have cash, that our country doesn't go bankrupt. But other than that, it's not really worth anything. So why is that same piece of paper that has 100 on it worth $100? What's it backed by? It's not backed by anything other than the U.S. government says we promise to create a liquid marketplace for our currency so you can buy and sell currencies if you want to. Well, cryptocurrency is kind of the same way. It's not backed by anything other than what people are willing to actually pay for it. has no physical form and exists only on the network. And its supply is not determined by a central bank. So you can create as much cryptocurrency as you want, or you can do what's called a fork-off, which is a spin-off, and make more if we want to. All right, so what are some of the risks associated with cryptocurrency? And I'll show you how the process works to buy and sell. Risks. The first risk of a cryptocurrency, it has no intrinsic value like a fiat currency. Fiat currency is like a government currency that's backed by a government. So it has no intrinsic value. If all of a sudden people say, well, we're just not going to use Bitcoin anymore. Well, the value of Bitcoin goes from its current value, which is right around 15,000, could go up to 20, 25, 50, 100, could go down to $200 a share. But it only goes up and down because people are buying and selling it. Perfect example is, think of baseball cards when they're in their heyday. You might have bought a baseball card for $200, but 10 years later, it's worth 25 cents. Why? Because people aren't willing to pay for it. It was only worth $200 because that's what people were willing to pay for at that point of time because it was a hot item. Well, cryptocurrency is the same thing. It might be worthless 5 years from now because nobody decides they want to use it anymore because they're using a different form of money. So the risk is it has no intrinsic value. You can't exchange it and say it's worth gold, so it's backed by something. It's very, very volatile. So let's take a look at the volatility of how these go back and they work. As an example here, so volatility. And by the way, let's see where it's not worth anything. Bitcoin, we can see right here, and I'm on coinmarket.cap. But this just tells you some of the different currencies out there. This is Bitcoin, Ethereum, Bitcoin Cash, Ripple, Litecoin, a few of them, IOTA, if you kind of go down through this right here. This tells you the market cap. Right now the market cap of Bitcoin is, as of this, is $226 billion. $226 billion of an item that's not backed by anything other than whatever people are willing to pay for it. And they're only willing to pay for it because it's going up in value. So because it's going up in value, people buy it. What happens when it starts to go down in value? How do you make your money when it's starting to go down in value? Well, if we take a look at GE, big, huge U.S. company, part of the S&P 500, part of the Dow 30 industrial stocks, very, very large, well-established company that has all kinds of assets and earnings and actually makes a profit, actually has a service that people pay for. It has a market cap of only $151 billion. GE, great big company, actually has real solid assets. They own things. They own buildings. They own cars. They own manufacturing plants. They make profits. They do have services. They make money. 151 billion, or Bitcoin, 226 billion. So do you kind of see where we're in kind of you hear people say we're in a bubble right now. Well, why are we in a bubble? Just because people are buying it. Why they're buying it? Because it's going up. What are you investing in? I'm investing in technology that may or may not be around in the future. I'm sure there's going to be in the future some type of digital currency or cryptocurrency, but which one is it? And why are we paying $15,000 right now? Whatever the current price is, why are we paying $15,000? Right, the current price right now, this one is $13,492 per coin. Why are we paying that much for it? Well, because it's going up. Why is it going up? Because people are buying it. Why are you buying it? Because it's going up. Why is it going up? Because people are buying it. That's really the reason. So it's kind of a strange nature to kind of go back and take a look at that. So, volatile. So it has no intrinsic value. Number two, these are some of the risks. It's volatile. These things go up and down like crazy, up and down, up and down, up and down. If I take a look at Bitcoin just today, the high point today was 14,600. The low point today was 12,500. It's a difference of $1,000 in just the last 12 hours. A difference of $1,000. In the last 24 hours, it was up here at about 15,200, and the low price was 12,500. That's a difference of almost $2,500 in just 24 hours. I mean, that's volatility. I mean, if you want volatility, this is it. So if you're afraid to invest, say, oh, you know, this was a few weeks ago, this was actually $20,000 of Bitcoin. Intraday today, it hit 12,500. I mean, if you want to invest your entire family's financial life savings in something that's that volatile, that's a really scary thought process. So some of the risks is that this is a really volatile process. You could actually lose a lot of money. False sense of expectations. The reason I'm doing this quick analysis here for you guys today is because I'm getting a lot of investors that say, well, what if I invest in cryptocurrency? Should I invest that versus regular stocks? Well, just take a look at this. This was at a year ago. If you just take a year ago, this was out here at about $700 a share a year ago, and it reached all the way up to $20,000 in 12-month time frame. $700, $20,000. $700, $20,000. These are just huge rates of returns. And so because it's going up like that, you get all kinds of people thinking that this is normal. And then when they come back to the stock market, I don't want the stock market. It was only up 9.5%, 10%, maybe 14% this year versus, 15,000 or 14,000% this year. Why do I want to invest in 14% versus when I can get 14,000%? It gives a false sense of expectations, and you have a lot of people that are trying to say, I want to invest in Bitcoin because I want to be one of these new cryptocurrency multimillionaires, and yet what you're actually investing in has no real asset. It's only going up because people are willing to pay that price for it, like baseball cards. Baseball cards only went up in their heyday because people wanted to pay for them. You go back, you don't get anywhere near the same amount you got for them 10 or 15 years ago, not even close to them. They've dropped dramatically in value because people just don't pay for them anymore. Why don't they do it? Because it was just a really hot fad. Is digital currency a hot fad? I don't know. I think there's going to be some form of it going to be used extensively, but which one is it going to be? There's over 1,000 different kinds of cryptocurrency out there right now. Which one's going to be the one out there? Right now you're just hearing Bitcoin because it was the first. But the first doesn't mean it's going to be the one that's actually used. Let me go back and look at Betamax. Remember Betamax? People had VCRs and Betamax. Who even has a Betamax or a VCR? Either one of those anymore. No, nobody does. So we all have digital recorders. But you talk to an older person, they'll say, I taped something today. I taped this show. You talk to a millennial, they have no idea what we're talking about. Things change. So just because Bitcoin was first doesn't mean it's going to be the one that people are using. And right now people are willing to pay anywhere between $12,000 and $20,000 for it because it was the first one out there. And it's only going up because people are buying it. People are only buying it because it's going up. It's not real. Right now we're in the middle of what's called a bubble. At some point it will pop. I don't know when, how, but at some point it'll pop. So what I'm just saying is we have a false sense of expectations. And you see a lot of these kids saying, well, should I invest in cryptocurrencies because I can make so much money? You can, but here's the answer to that. If you want to invest this as an actual investment where you put the majority of your funds, the question you have to ask yourself is, why is it going up? How long will it last? And more specifically, what will I do to correct the trade, fix the trade, protect myself if I'm wrong? And don't just say, I'll put in some kind of a stop loss so I won't lose my money on a stop loss, because that's not how it works. You can minimize that, but what happens is most people don't actually follow the stop loss. They'll get back in again. So they'll find the next time it bounces a little bit and they'll buy again, and it just drops even lower. They take another loss on that. So if you know specifically why you're buying the exact crypto you're buying, what's the reasoning behind that, and why it will be the market leader, and not just because it's hot right now, because it will be the market leader, and you know what to do if you're wrong, how to fix it or repair it, then yeah, go ahead and put a lot more money into it. But I don't know anybody that I've actually met so far that can give me really any feedback on that at this point because it's so new. So it has a false sense of expectations. People just believe that they're supposed to get 14,000% return every year now on these cryptocurrencies. User address error. Here's a big one. If you're using your digital wallet to buy something, and you have your address that you type in, I'm going to transfer my funds from my digital wallet to this person's digital wallet, and you type in the wrong digital wallet, that money's gone. Remember, once it's gone, it's approved by the data miners, which are also sometimes called nodes or peer-to-peer network, whichever one you want to call it. Once you place that trade, think of it just like putting in your credit card into a little credit card machine, and they approve your credit card. Once it's gone through and they say, yep, the funds are there. It takes a couple days to clear on your credit card, but once they say the funds are there, it's done. Remember, guys, you can't go back and reverse it, because once it's been approved now, it's part of that blockchain. That blockchain can never be rewritten. It's done. It's permanent. So if you transfer the wrong amount of money to the wrong person, you can't correct it. You can't fix it. You can't ask for your money back. You can't refund it. It doesn't exist. So that's just how it works. Loss of a wallet. If you lose your wallet, if you forget your wallet, it's not like the wallet you put in your back pocket, but it's a digital wallet. So think of it as a wallet in your back pocket, but it's digital. It's online. If you forget your digital wallet ID number, and it's like a long 30-digit number, and you don't have it someplace and you forgot it, your money's gone. So that's a process. It's non-reversible. Once that transaction is approved, there's no way to refund it, issue a credit. It's just done. So you need to make sure that whatever you do is correct. If you're buying a house and you're doing a transfer of a house and you're trying to do this, and I've heard a couple people actually able to do this now in New York now, but you're buying a house and you pay the wrong person, that money's gone. You don't even know who it went to. It's just gone at this point, and you'll never give it back. It's part of that blockchain. Somebody could actually hack a payment gateway. So if you're going onto somebody's website to buy something, and that company says, oh, we'll take money through your digital wallet, through your currency crypto coins, they can actually hack that, and they can put in the wrong digital wallet that receives it. So when you transfer money from your digital wallet to their digital wallet, you could actually pay the wrong digital wallet. And again, once that money's been paid to the wrong digital wallet, it's gone forever. It never comes back. And the president can't get it back, Congress can't get it back, the Fed can't get it back. It's just gone for good, because these are all private keys, which nobody knows on the other end who actually really got that. Unregulated ICOs. Now, cryptocurrencies come out what's called an ICO versus stocks, which come out in an IPO, initial public offering. These are called initial coin offerings. Because these are unregulated, they don't have the SEC, they don't have the Federal Reserve, these are unregulated coins. Anybody in the world who wants to create their own cryptocurrency can. And there's even one I was online reading about. A dental company created their own crypto coin for paying for dentist office visits. It's a dental crypto coin. I mean, anybody in the world who wants to can create your own cryptocurrency is my point here. So because of that, these markets are completely unregulated. So when you're doing any research and you're trying to find out which of these you want to buy, there's no real background behind them because there's no regulation saying the information has to be correct or is even accurate. So these are completely unregulated out there. And what happens if you embrace the wrong crypto? So right now everybody's buying Bitcoin because that's the big market leader because it was first to market. What if at some point Bitcoin is the one that nobody uses, kind of like the Betamax for the VCR? What if everybody says that's a good one now because it's just a much better picture than a regular tape, VCR tape, so that's going to be the better one. But what if all of a sudden nobody says it didn't win, and all of a sudden you've got all this money that you've invested in the wrong item? It could go belly up before you say, and you might say, oh, I've still got a feeling, I know it's still going to come around, and you lose all of your money because you embraced it in the wrong crypto. Remember, there's over 1,000 different kinds of cryptos right now, cryptocurrencies. So if you embrace in the wrong one, you could lose your money. Those are the real risks. So if you understand the risks, then maybe you say, okay, I understand those. I'm willing to actually move forward a little bit and see them after. So who are these peer-to-peer networks, the miners or the nodes? A cryptocurrency like Bitcoin consists of a network of peers. Every peer has a record of the complete history of all transactions and thus the balance of the account. So for every single cryptocurrency that's out there, it's created by what's called a miner. Now, a miner is, if you've ever seen these, they're just like a big, huge server room that are they just crunch numbers. What they're doing is, think of it, they're trying to break the password on your phone or your computer, that 256-bit encryption code. These miners are just running this data 24/7, 365. They're trying to break that encryption in this crypto puzzle. When they break it, that's a new coin. So that's a new coin at that point of time. Now they get paid because they now own that coin, or that coin is really just a digital coin, a digital number, so they own that. They can now sell that based on whatever it's worth. And so that actual coin has a complete transaction record from the day that it was created to who bought it, who sold it, how much was bought for, how much sold for. Now, not who individually, but which digital wallet bought or sold it. But your digital wallet isn't associated with your name, so it's just a digital wallet. So that all that information, that whole balance of all transactions, all buys, all sales, are actually updated by these Bitcoin miners, sometimes called peer-to-peer networks or nodes, N-O-D-E-S, and they follow that whole blockchain. So when that blockchain is now, it started from each individual transaction all the way through who buys it and who sells it, and it never ever stops. It just keeps on going. But every time that these data miners get a new digital coin or a new blockchain, every other company out there, every other data miner has that same transaction record of that blockchain, which is now copied. So these cryptocurrencies like miners out here, every peer has a record of the complete history of all transactions, thus the balance of every account. So if one miner says we're closing our doors today, and you still have 2 million other miners out there, we're still got power. You don't have to worry about any one thing taking down everybody. As long as one of them is up and running, we're good to go. Now, the initial transaction is immediate. So every time now that this data miners have created a new coin and they put it on a blockchain and they start to buy it and sell it. And by the way, you can buy a fraction of a Bitcoin. You can say, I want to buy only $10 of this one Bitcoin. Well, if you buy $10 of that one Bitcoin, it's now part of a transaction history which gets placed on a block, which is now part of that new blockchain. And so you own a piece of that, somebody else owns a piece of that, somebody else owns a piece of that, and every time that one is bought or sold, or any type of transaction to that, it's added to that same blockchain, which can never be removed because it's there for history. So the initial transaction, every time you buy or sell something with a cryptocurrency, it's immediate. But it could take anywhere from 30 seconds to 24 hours to actually confirm it and add it to the blockchain. Miners. Now miners, what they do, these Bitcoin miners, they announce and they confirm transactions. Every time you actually want to buy something, instead of putting your credit card in a credit card machine getting approved, you actually transfer a digital number from your digital wallet to somebody else's digital wallet, and that digital number gets transferred. And that digital number is associated to a value of one of your crypto coins. So when you transfer some part of your digital number to somebody else's digital wallet, you're actually sending cryptocurrencies. in order to do that, it has to be confirmed. So as soon as you place that transaction and you hit the enter button and it goes across to all of these different data miners at the same time over the internet, and then everybody gets a chance to then update and confirm, say, yep, that digital wallet's trying to send you something is a correct digital wallet, go ahead and accept it. And at that point, it's approved. And then they'll go back and they will then go back and update the blockchains. Now, anybody else that takes a look at the blockchains or tries to do another transaction will say that that coin is now in somebody else's digital wallet and is confirmed by each one of those blockchains. So these data miners hold the blockchains, and they create new blocks for blockchains by solving cryptographic puzzles. So in other words, in order to get a new digital coin, these data miners have to run a mathematical algorithm and try to crack a digital cryptographic puzzle. This, again, it's like cracking the password on your phone. And you know how hard it is. I mean, you know that when we had some attacks here in the United States recently, and the government wanted to get into an Apple phone, the government said we don't have the ability to actually crack the actual technology in the Apple phone. It's just going to take way too long to do it. Well, the data miners do that, but they're just running, hundreds of computers at a time, 24/7, trying to crack an individual code just to find one individual coin. When they have that coin's added to the blockchain, and now they can go ahead and people can actually buy and sell that digital coin. So how do the data miners, how do they stay in business? Well, because they crack these cryptographic puzzles right here. When they crack those cryptographic puzzles, they get a coin. When they have the coin, they're rewarded with that cryptocurrency for what they just did. And now they can sell that cryptocurrency for whatever the current value is at that point of time. And they can sell it, they can put it online, and we can go back and we can buy and sell it. And that's what happens. All right. Using cryptocurrency. Like I said before, once you use it, it cannot be reversed. It's done completely. Once it's added to the blockchain, you can't go back and erase all of those. That blockchain, once the blockchain is set, it can never be removed, replaced, reversed, anything. It's done. And nobody knows who bought it, because it was all just this digital wallet transferred this digital number to this digital wallet. That's all that it was. Now, you're the only person that actually has your private key. In order to send money, you have to have what's called a private key. It's part of your wallet, which is the next one coming up through here. I'll show you how that works. These are anonymous. Nobody knows who you are. The transactions and accounts are not connected to real-world identities. In other words, when you have your digital wallet doesn't have your name on it. Your digital wallet only has a number associated to it. So if you lose that number, you lost your digital wallet. So you got to be really careful with that. It's very fast. These transactions can happen in a matter of seconds, and you can transfer money to anybody at any time globally. If you want to transfer money to somebody on the other half of the world, you can do it in 15 seconds. You don't have to worry about going to Western Union. You don't have to go to your bank. All you have to do to transfer money is to go online to Apple Pay or Google Play, to the Apple Store or Google Play, and download a digital wallet. Now, if you take a look at the largest one out there is called Coinbase, COINBASE, and it's one of the top 10 digitally downloaded softwares in all of the Apple Store. So if you're trying to trade them and send them across globally, you can send that money to anybody around the world in just a matter of seconds. You don't have to worry about going to the bank. Like we said, you don't have to worry about going back to Western Union. You can transfer your money to anybody anytime. So if you live in a different country and want to transfer your money to somebody else, different country, for whatever reason, you can do so without any interference from anybody else. Nobody can say you can't do it. Nobody can tell you how much money you can do. You don't have to worry about approval from anybody. It's really, really quick and very secure, because everything that you have is stored inside of your digital wallet, which is your public profile. And your public profile isn't associated to your name. It's simply just a digital number. And every time you send money, you're actually sending it with what's called a private key. And that private key, nobody can actually see who's sending that money and where it came from and where it went to. That part's private. So that's why it's a very, very secure transaction. So let's talk a little bit about those digital wallets where that money is being held and stored. You have two parts to it. Now, these digital wallets, like I said, you can go to Apple Store or Google Play Store, and you can download these digital wallets. And one of the top 10 apps on the App Store, like we just said, was Coinbase's digital wallet. So these are very popular right now. So the public key part. The public key is a string of anywhere from 26 to 35 characters that's accessible by anybody on the Bitcoin ledger. So anybody who can take a look at that Bitcoin ledger, that blockchain, and these are anybody can go back and do that, they can see how much money is associated in any digital wallet. They can actually see where that money's at. They can't see who owns that money or how much money they've transferred to other digital wallets. They can't see that part of it. But they can see how much money's in each digital wallet. But who holds that wallet, who controls it, how much money they have other places, that's not listed any place, because all you have, the digital wallet, is associated with just a number, and that's who you are as a number. So if you lose your number, you've actually lost your digital wallet, because remember, it's not in your name. You can't say, oh, look it up by my first name, my last name, my social security number. That's not exist. Now, anytime you want to actually take money out of your digital wallet and send it to somebody else, you have to now have what's called a private key. Anybody can view the Bitcoin on any public key address. You can see actually what's in there, but you don't know who actually has that. In order to send it, to access those coins and send them somewhere, you have to have a private key is needed. A private key is around 60 characters and looks something like what's below right through here. This combination of these two keys allows anybody that has cryptocurrencies holders to sign transactions and prove that they actually have the account and then send money back and forth. If you lose your transaction, you don't have access to your digital wallet. If you don't have your private keys, you can't send money back and forth. So this is how you send your money back and forth, was your digital wallet, what holds your public key, and then from that you use your private key to actually send the money. Nobody sees the private key, and when you send that money, it goes from one wallet to the other wallet. Nobody knows how much money you paid to somebody else because it's not listed. That private key is completely private and nobody else actually has access to that. Nobody. So if you want to pay your babysitter, if you want to pay for a car, if you want to pay for whatever, nobody knows how much money you paid for something and where it went to and when it went to. It's not available to anybody. So that's private. That's one of the benefits of cryptocurrency, is nobody has any involvement with that other than you and the person you're paying. It's not, no government has access to that. Nobody has access to be able to see what you're trying to do. That's your digital wallet. Now, let's talk about investing and using cryptocurrencies to invest. The goal really is just to invest. I'm going to buy a cryptocurrency, and my first thought process is, and hopefully you believe this because it's important, I'm not looking for 15,000% on my money in the next 12 months. Those are unrealistic. If they happened, hallelujah, that's fantastic. But do I expect them to happen? No. I'm just going to invest in cryptocurrencies because I think it's going to be something everybody's going to be using sooner or later. And if we go back to what we just kind of showed you earlier, which was the market cap of some of those items on here, on the cryptocurrency market caps, we said Bitcoin was number 1, Ethereum was number 2, Bitcoin Cash, a spin-off Bitcoin, is number 3. Ripple, and now this is kind of an exciting new transaction. These right now are trading about 97 cents a share. They're very per coin, so they're very, very cheap. But this is one that a lot of the banks are getting behind because they see digital currencies as kind of the future, because we're slowly moving away from paper money. I mean, it's old, it's archaic, it's no longer necessary. It's just not what we have to do anymore. We have to always replenish it. So everybody knows at some point that is going to go away. So a lot of the banks and institutions are trying to move into what's called Ripple, the Ripple coin. And it's a different, not just the actual coin, but it's a way of actually using the transactions as well. And these are only 97 cents a share, so they're fairly inexpensive. And now, if this is the technology, you can see the circulating supply out through here. 38 on here, so we've got 100,000, million, billion, so we got about 38 billion coins out there. That's a lot of coins out there compared to 16 million over here on just the Bitcoins. So 38 billion because everybody believes that technology is going to kind of take off through here. Now, Microsoft just recently backed IOTA. I think it was Microsoft and Samsung are using IOTA, and they're trying to do some type of research to maybe put this into, build it into their phones and build it into their computers so we can actually use this type of transaction, digital currency, to go back and forth. So that's a one that's kind of exploded just recently. It's only 337 out here. So those are two big ones that people are kind of getting into, Ripple and IOTA. Litecoin was actually created right down through here. Litecoin was created as a competitor to Bitcoin. It's just much cheaper and it's faster. Where sometimes Bitcoin might take a couple hours to even 5 or 6 hours to actually approve the transaction. It'll get, I mean, to confirm it, it'll get approved immediately, but actually to confirm it, which means that money's there and actually on the blockchain, could take hours, where Litecoin takes about 30 seconds to 2 minutes. So it's just a much quicker process. So a lot of people are trading Litecoin now because they're just much cheaper than Bitcoin, but they're a digital currency. It does the same thing as Bitcoin, just cheaper and faster. And then Bitcoin Cash is a spin-off, which is called a fork of Bitcoin, and it's trading around $2,800 right now. So a couple of big ones right now. Everybody obviously is aware of Bitcoin. Ethereum is a new product. This is more of an exchange and a currency both. Bitcoin Cash is a currency. Ripple is one that a lot of the banks are starting to back, and you got to think about this. If the banks are backing this, you know, he who has the money has control, and the banks actually have most of the money right now. So this might be a really big technology that replaces even things like Bitcoin. We might see Ripple coming out there. I'm not telling you guys to go out and buy that. I'm just saying, do your research. You know, what's the reason that people are into some of these different items that are out here right now? So the goal here is really to invest. I'm not trying to put my money into this and saying I want 15,000%. If I'm going to invest, whether it's the stock market or it's real estate or it's the bond market or it's whatever I'm trying to invest in, or it's gold or it's, you know, art or whatever, I'm trying to invest for the long haul. I'm trying to diversify my portfolio. So obviously, digital currency things are going that way anyway, it should be something for us to take a look at. So the goal is really to invest and not try to say I'm trying to have unrealistic expectations. What's nice about these, you can trade them 24 hours a day. They don't shut down, because at some point these digital exchanges, they just run 24 hours a day. They just don't close, unless they actually close because they went bankrupt. Research and reading charts, you better be really good at doing some research. I don't want you guys just to go out and say, oh, I'm going to go out and buy Ripple because Mike just said that it's being pushed right now and backed by the banks, and they're doing a lot of the research behind Ripple, trying to make it the new one out there. Don't go out and buy something because I just covered it on here. Go back and do your research and find out, what do you honestly believe based on the news that's out there that you think is a good one to go back out and do. And then learn to read some of the charts, because they do have charts like anything else. So if we're trading some of these, they do have charts that we can go back and use to find out how we're going to go back and take a look at these. So for instance, this right now is one of the exchanges you can buy Bitcoin on, and this is Bitcoin compared to the US dollar. And you can just see that over just the last few months, this has gone from its price down here of about $4,000 a share all the way up to $20,000 a share in the last 3 months, and now it's back down to $12,500 a share. But you can see, like anything else, they have support and resistance lines. You know, we've talked about reading charts in other classes, so learn to read some of the classes. And you saw that right now as we read this one here on Bitcoin, went up, had the nice pullback, went higher, had a pullback, higher highs, higher lows. And we first came back and we started to break through the floor right here at about 16,008. We broke that first floor right here. We now went into, instead of an uptrend, went into a downtrend at this point of time right through here. Because we broke that floor right here, our mouse is at that point of time. We broke that, we started a downtrend. So like anything else, these are charts of currencies, and they have uptrends, downtrends, sideways trends, support trends, resistance trends, things like that. So get good at reading charts, how you can go back and when to buy, when to sell. So don't just start buying because you think it's going up, because you might be buying on the way down. So learn to do your research, find out what you're buying, what you're trying to buy, and how to read some of those charts. And the last big one for this and trading these, don't use your rent money. These are so volatile right now. If you use your rent money, you could lose your house. So this should be done with money that you don't mind losing. Think of it like going to Vegas and gambling. I'm just going to put a little bit of money here until I really find out what's going to be the true digital coin that people are going to start using going forward, and then I'll start putting more of my money towards that a little bit at a time, just like you would invest any other way, a little bit at a time, start to add to your positions. So add a little bit of money at a time. Now, some of the different exchanges, if you're going to go open an account, you're going someplace to open an account, some of the bigger places to use here in the US or in North America, for us would be Coinbase.com is probably the largest one in the US. Very simple to open up an account. Just go to Coinbase.com. It's the one that has one of the top downloaded softwares apps for your phone, Coinbase.com. And they also have, that's where you can actually buy the currencies or just sell them. And then they also have what's called GDAX, which is a digital exchange. So GDAX is Coinbases.com digital exchange. Coinbase is just where you can just, I just want to go buy it. GDAX is where you can go back and trade it. It means you can trade it against other items. So you can say, instead of just saying I want to buy this digital currency like Bitcoin, or I want to buy Litecoin or Ethereum or Bitcoin Cash and just own it, and then I can put that in my digital wallet and I can use my digital wallet. Well, GDAX is an exchange where you can say I want to buy it against this. So I want to buy Bitcoin and sell Ethereum at the same time. So maybe you had Ethereum, so you can place a trade. It's a currency pair, and you can buy and sell one versus the other versus just buying it on Coinbase to put in your digital wallet to use to spend. GDAX is where you actually go back and trade it. I'm going to buy IBM, and with the cash, I'm going to buy IBM. When it goes up, I'm going to sell it, and then with the cash proceeds, I'm going to sell IBM, and I'm going to buy Bitcoin Cash. So that would be more of an exchange of trades. This would be more like your brokerage firm. This would just be like adding money to your bank account. CoinMama.com, BitQuick.co, Gemini.com, Bitstamp.net, iBit.com, and Bitfinex.com are some of the more popular ones that people go back and use. Now, Bitfinex.com was one I just had up here just a second ago. It's an exchange where you can actually buy and sell, but you can actually use margin, which makes these really, really, really dangerous. But I just want to kind of let you know what's available to you. So if you're out here trading on Bitfinex, you can go back and say, okay, I'd like to do a trade right now. You're looking at Bitcoin versus US dollar, and that's the current price right in here right now. And you can see that already down today. It's already down today. It's down 16%, down $2,400 just so far today. But I want to go back and do a trade. So if I'm going to trade, what do you want to trade? I want to go back and trade Ripple. Now what do you want to trade Ripple against? Well, I want to trade Ripple that I actually trade Ripple with the US dollar. So if I have Ripple, I'm going to go ahead and and convert it to the US dollar, or I'm going to convert Ripple right through here into Bitcoin Cash. So I can buy Ripple or Bitcoin Cash. So if you're going to go back and trade it, what's the value of it as you go back and trade? So this is kind of where you say, I just want to go back and trade a pair. You can see where it's kind of going up and down. So it's worth, one Ripple is worth 0.000007430 Bitcoins. So I want to go back and trade one versus the other. So a lot of things you can do. If you just want to place a buy, you can place a buy at a limit price. I want to place a buy at a limit price, or a market or a stop limit. In other words, let's place a buy at a limit, and I'd like to buy Ripple. And what if I just wanted to actually just buy Ripple? So I go back here for trading, and go to Ripple, to the US dollar. And right now we can see if it's kind of trading, wait for it to go back and load, that it is right now about 90 cents a share. And you say, I'd like to buy this over here at a limit price of, and you can go back and type in the amount you want. You can say 0.8900, whatever you want. And so if it ever pulls back to 0.89 cents during some time during the course of the day, we can go back in and just hit exchange buy and just go back and buy that. So it's kind of a nice way to go back and trade. Lots of different ways to trade on some of these if they have an exchange as well. And the ones that have some of the exchanges are the really ones you're after. So you can deposit your money to the exchange, or you can deposit your money and just buy, and just like Coinbase, and have it in a wallet to actually spend it. If you don't want to spend it but you want to invest in it, then you really want to go back and use something that has an exchange, like GDAX or Gemini.com or Bitfinex.com. All of those have exchanges, and you can go back and trade them throughout the course of an exchange. Some different ways. So hopefully that gives you a little bit of research on what digital currency is and how it works. Please do your own research on these. Don't just buy something because you heard it was a good way to buy. Because remember, just because it's out there, there's over 1,000 different kinds of digital currency right now. Just because it's out there doesn't mean it's going to actually go forward. Think of it like the Betamax, for those of you that know what it is. Or for those of you that have been around longer, think of it like Nokia BlackBerry. It was the #1 best phone out there, Nokia BlackBerry. Everybody in business had a BlackBerry phone. BlackBerry, BlackBerry, BlackBerry. As soon as the Apple smartphone came out and then the Samsung came out, nobody has a Nokia BlackBerry anymore. They just don't exist. And it was the major 800-pound gorilla in the marketplace. But a better product came out that was better, more efficient, and also the BlackBerries just went by the wayside. So please do your own research. Don't just buy something because it's going up. And again, digital currencies don't have a real value associated other than what people are willing to pay for them, just like baseball cards were a few years back. Buy slowly. Don't buy a whole bunch at one time. These are so volatile. You say, I don't want to miss out. Well, you don't want to miss out, but people, when Bitcoin was at $20,000 just a few weeks ago, and now it's at $12,800, people didn't want to miss out and was at $20,000. Now they're thinking, man, I wish I would have waited a little while. Again, we're in just this big bubble right now. Nobody knows what's going to happen, so buy slowly. If you're going to invest, just do a little bit at a time with very small amounts. So with that, guys, good luck on your journey. Remember, we are here at Income Trader and InvestEDU to help you along these items. And as we find out more about how we think it's a really good way to actually invest, the correct way to protect your portfolio, I'll post more videos and do more classes for you on cryptocurrencies as well. So use us for your information, because you know it's going to be detailed and valued information and not just full of all kinds of pipe dreams for you. So good luck on that journey, everybody. My name is Mike Coval from Income Trader and InvestEDU. Thanks a lot.